But first, let me introduce you. Nancy Wallace is a professor of finance and real estate and holds the Lyle and Rosalind Payne Chair in Real Estate and Capital Markets at the Haas School of Business, University of California, Berkeley. She is chair of the Real Estate Group, co-chair of the Fisher Center for Real Estate and Urban Economics, and directs the Real Estate and Financial Markets Laboratory. So this is you have a chance to hear from
the worst state in the United States.
Nancy's very experienced in the whole real estate business and very involved in climate change research. So let's start here. We've heard today of many ways the insurance industry is impacted by changing climate. Insured losses are rising and insurance premiums are sometimes rising to levels where properties are considered to be uninsurable. You've been studying the impact of California wildfires. How big is this an issue now, and is it still growing over time?
The answer is yes, but it's also the interplay between, as you've heard, the regulation in California has been very prohibitive for the use of actuarially informed models. So we can't use probabilistic models. That's beginning to change. That changed in October of 2023. And then additionally, we're not allowed to use, or we weren't until October, and it's neither of these things have still been put into place full force, to include the reinsurance rates and the rates for insurers. So we have a lot of distortions because of this lack of pricing. And if anything, the rates are low now. The rate request in October was 30%. So people are being hit with high new premia, but the bigger concern is lots of basically cancellations of policies and a move to push a lot more into the residual market, which is called the California Fair Plan, and that only insures fire and smoke damage. So you have to get other forms of insurance, property and casualty insurance, to have any insurance. So it's very expensive and very marginal. So the answer is we don't see the pricing issues right now. What we see are very substantial loss rates. We've had multiple summers where the payouts on wildfire actual realized losses have been between $18 billion and $21 billion. So 3 summers with 18, 20, and 21 billion. And some of these are, one of the summers was for 2 fires. So when you have a major wildfire in a very expensive real estate area, and many of the areas that have been allowed to develop the most because of this pricing distortion are where some of our most expensive real estate is. And a simple thing like a Tesla crash, when Teslas crash, they burn very hot and it sets these fires off. So I think the story is unfolding. Right now it's borne by the insurance industry, and their response to this is to cancel policies. I think it's brinksmanship with the regulator. We have slightly a captured regulator. They're trying to figure this out. So we're in a transition to something we have no idea what it is.
Well, so there's one other thing you didn't say about the insurance. When a house gets burned,
Yeah.
What are the choices that the homeowner has to make?
So that's another interesting feature. I know there's been a lot of dumping on California. I'm from California. Maybe I should. I've heard some very positive things about New York. Maybe I should think of some very positive things to say about California. But that is another problem in California. The policy, given the restrictions on insurance pricing, the other force that was in play in California was basically allowing or forcing people to rebuild at the same place the homes were burned. So we had multiple repeats of basically wildfires. It's not as extreme in the flood insurance areas, But it is there that the way to maximize your payout on a major fire is to rebuild in the same place. Now that we govern ourselves with propositions, I'm sure you've read about them. That's another challenge. And there was a recent proposition that was passed in 2020 that is going to allow people to move whatever the compensation is for the damage on the improvement to another property and move the basis along with it. So the tax basis would move, and then the insurance company would pay out on what the loss was of the existing home, and you could sell the land. But that's as of that was passed in 2019, and it's now policy as of 2020. But that's been a big problem. So most of the rebuilding happens in the same places where the homes originally burned.
And one of the things that you've observed is that actually, when you look at house values and the size of the houses after a fire, they're actually bigger. The house values have gone up once they're rebuilt, and the houses are a little bit bigger. So the fire has done something, and you have a little model that you've talked about. I don't know whether you can sort of explain this in a simple terms so
Yeah.
that we can
I've been thinking about this.
appreciate how this makes sense.
So in part, I mean, when we started this research, we thought the default rates would be elevated because of fire. That seemed like a reasonable outcome. I teach we have a master's in financial engineering program, and I had a student project, and we were doing all kinds of cool modeling, time series modeling, trying to create these stochastic climate models that need to be built for pricing contracts. And they kept finding with the data that the probabilities of default were actually nearly non-existent in these fire areas. And these are areas where 2,000-3,000 homes burned. One of our sites, 9,000 homes burned, and yet we did not see elevated default. So that seemed quite strange. And partly thinking about it, fire is an unusual climate risk in that there is an enormous externality dimension to fire, that if you take care of your home less well, you leave a lot of brush, you don't have fire resistant roof, you don't have double pane glass, you're and you're in a fire hazard area. If your home burns, my home is more likely to burn. So these externalities, these spillover externalities lead to lack of investment, usually for things like remodeling, because I can't be sure that you're going to improve your home, and therefore I'm somewhat reluctant to invest in mine. But similarly, when you have a fire and everyone's home burns, it establishes a kind of what we call a coordination externality, that suddenly all of us want to rebuild. That's the proper solution to this externality. And the reason for it is that the insurance company is going to cover the rebuild. So the incentives to rebuild are extremely high. The way the policies pay out incentivizes you, especially we heard earlier today that there's a big demand push when 3,000 homes burn. We've had a lot of cost increases, but the policies include things like covering it. Most people have riders on it, given the expense of home insurance in California and the value of properties that are being insured. Although there's a certain level of underinsurance, most people are insured. And then there's the personality, the stuff inside the house, and you don't have to rebuy that. So you can take that personality part of the compensation and build a bigger house. And what we're finding in these large fires is that on average, properties grow by about 5%. They're bigger, their square footage is bigger. They're more valuable. Obviously, it goes along with being bigger. People do not move from these areas, so there isn't gentrification that we see in some of the climate disasters in other areas. And we see very little prepayment and very little default. So casualty insurance is for banks. That's who's being insured. It's working well. The problem is that the payouts on these fires borne by the insurance companies without flexibility in pricing is not supportable. And so that's leading to this crisis, which really came to a head in October. Well, it was before that, but a semi-resolution was achieved in October. It is simply not sustainable in California with this very heavy burden of compensation from these devastating fires with very high loss rates under the current premium structure.
So it seems like everybody's better off, except the insurance companies.
Exactly.
So it's not clear whether we hope for more fires or less. If you've got a house in the Sierras with you might be happy if it burns down. But the insurance companies certainly are not. And so one of the things that you've followed up on here is, of course, if the insurance companies really could reprice, what would the prices look like? And a different way of saying that is sort of, how do you estimate the actual costs and damages due to fires? Because probably it's really not a good thing to have fires. Just
agreed. So part of the initiative that I've been working with the Department of Energy and that with our lab that I'm running, is to try to figure out, A, can we improve the models? B, can we assemble the needed data to understand the losses? So that's all the real estate risk. That's what's at risk here. And then working with climate scientists, I'm an economist, but connect the dots between the classes of model that climate scientists are using and the needs for models in people and financial markets, which is forward pricing of these contracts. And we heard mention of this at lunch of forward-facing stochastic models in climate science. Most climate scientists, that's not their focus, but the focus of most finance professors is to price bonds that pay out in the future. So that's highly relevant for the mortgage market. It's certainly relevant for insurance policies, but building the infrastructure to price that accurately, that's a technological problem. And we're sort of by working together with climate scientists, we're moving forward on that. The problem again, though, in California is the way the regulation of pricing has been set up, that the incentives to actually do that and implement these or do some of the hard work of understanding even how much consumers understand this risk, because the distortions have been so extreme in allowing people to live and build homes in these very risky areas. We know very little about the consumer. We don't have a pricing history of loss given extremis and fire damage. And we didn't have the data sets. So part of this is developing the infrastructure to do this properly. And truthfully, we heard a lot this morning about mitigation. So that's another argument in California that's on the table now that we're able to think about actuarial pricing, using data properly, thinking about forward pricing contracting, is to think, well, how do we think about the mitigation problem? So what was proposed initially was that the quid pro quo was that homeowners would mitigate and then insurance companies would provide discounts. Of course, the insurance companies were not excited about this because the going in problem is the premium aren't high enough to cover these risks. But similarly, the problem right now, when you have a stock that's been built in the wrong place, and many of the structures aren't adequate to protect against fire, we need capital markets to provide, think of it like second loans, so that this mitigation can actually happen. And right now, we're experimenting with products that potentially could be used for that mitigation problem. But to the panel that we heard this morning, mitigation is going to need provision of capital markets for homeowners to even think about doing mitigation, because it's expensive and it's prohibitively expensive in some areas, those will become stranded assets perhaps. But on average, it is just expensive. And the signals from the climate risk are not strong enough to get people scared enough to do it. Because climate is very massive fires are rare events. They're predictable in certain areas, but on average, they're very rare. And so people tend to not think deeply about scary events, and we really know very little about how people perceive their own home and what its risk is. And because the insurance prices haven't forced them to think about this, that's another real impediment in California to get people even to be willing to think about mitigation. And then, of course, the insurance companies to think about what their part of the story is. And then on the optimistic side, and I think this is the good news from California, we are experimenting with new loan products. And one of those loan products that could potentially work is a tax assessment second loan. So that would be a loan that would be paid back as part of your property tax. It would be a securitized product. And this can be very, very patient money that stays with the home. So if you sell the home, it would be assumable by the next buyer, and it would be prepayable. So these are long paper. These are property assessed energy loans. We're using them already under new California tax code. Nearly everything that would be a retrofit would be eligible for a PACE. So PACE is the hope. There are people setting up these capital markets. There are banks involved, and we're setting up securitized markets in anticipation for how we're going to do mitigation.
So you would take your tax assessment, which probably is still a legacy from Proposition 13.
That's correct. You're exactly right. We're working on that
And
too.
so you've got this tiny tax assessment because you've had this property for a long time.
That is correct.
And then you added a chunk to it to pay for your
Retrofit. That's correct.
It's interesting
So
idea.
that's exciting. That
Yeah.
could be a
Yeah.
big, exciting new bond
Right.
market. I'm sure places, the investment banks, we should have interest in this. And it is a needed capital market development.
Mhm.
And I think developing the models, given now we'll have pricing, all of us that are teaching the next generation of finance students
Mhm.
will make that our focus.
So can we dig a little bit into your model?
Yeah.
You're estimating the probability that a house is going to be burned in a year, I guess.
Mhm.
And this is the sort of model that the insurance companies would estimate if they were able to or allowed
Yes.
to.
Correct.
But it also might be the sort of thing that a homeowner would love to know what the answer is.
I agree.
So what's in the model?
So what's in the model in California, the areas that are very risky are on the slopes of what's called the coastal range. So that's the area of the state that looks toward the Pacific Ocean. And then, of course, the Sierra. So when we have fire seasons in California is when there's a low pressure zone over the Pacific Ocean. So when that happens, the winds come from the Central Valley, which is hot, or it comes from Nevada and Arizona, coming over the Sierra, again, very hot. And so it's predictable. But the topography of the state brings that predictability. So we don't want to overprice insurance. We want to make sure that our models account for this important topographical correlation, and then the meteorological features that move with that correlation. So we're building models that are very sensitive to these spatial correlations. And we're also building models that are very sensitive to the time series. So in California, the way we had been pricing insurance up until October of 2023 was insurance companies were required to use a 20-year past average, so a backward-looking average of losses. So you could apply the average loss rate for a given site, but over the past 20 years. When you look at the climate data, the curvature of these risks in the last 5 years is extreme. So we want to pick up this recent uptick in risks and forecast forward off that. So we want to control for the spatial correlation using the models that are available now in handling huge data sets with hourly data. We can get very good climate data working with climate scientists and then match that to the assets. So we can model points in space, we can forecast forward and then map the houses onto the geographic locations. And from that, we should be able to get at least the way forward to develop good pricing models for things like a new mortgage market.
And it sounds like climate is a pretty key part of what your probability assessment is.
Absolutely. Climate is everything. Maximum temperature is hugely important, relative humidity, wind speeds, and it's also the directionality of the wind. We measure the slope and elevation for every point in space in California. We've gridded out the whole state so that we're literally looking at strings of performance by 2.5 kilometer grids, measuring those points and then adding the houses to that. And I think with this methodology and with the development, working with Rob, working with these centers, that we're going to have some really interesting models and interesting new products. And then again, on the new product side, so one of the big issues is, again, mitigation. How does a homeowner, or how do we get California homeowners to understand the risks? Because they haven't been priced, so why would you have to? And you know, if your home burns, the insurance company will pay for it. So you're very willing to, or more or less willing to rebuild, or at least that's what we see in the data. But we need ways of getting the information to people. So I have MBAs that have created apps that are on the iPhone that can literally generate reports for what the likely mitigation requirement would be for a home. And they're getting funded. So I have one student that was just funded by Lloyd's of London. That happened last summer. She's now in her second round of funding on a product that's on an iPhone that will generate reports. And we're going to see more of this. There is a huge amount of work to be done, but the good news is the technology is beginning to be there. These are tools that will be very useful. They'll help people understand where risk is and maybe how to avoid it. And it will help capital markets get more information about at the home level. Some of the more problematic things is there are also efforts to use just satellite data and look at the tree cover and look at how much junk is in the backyard. The problem is fire moves along the ground. And so in developing these models, there's a certain need for caution. And as a result of this, I became very friendly with the California Fire Marshals Association. These are the people that actually fight fire and the physicists that work with them to fight these fires and try to stop them. And again, I think back to the lunch speech, we need a lot more working together with engineers, physicists, climate scientists, finance faculty, and economists that work on these problems and work on them together. And I do think we're going to make progress because the need is extreme.
Well, this is pretty exciting, Nancy. I think you've put your finger on a lot of really important things, and it's some of it is tailored to California because of the way the insurance market is,
Yes,
but some of it is really appropriate for forest environments in Canada and the East, and I mean we've had
Colorado,
in Quebec, Colorado. I mean, so there are issues everywhere that you have information that could be very valuable for. I think we might have time for a couple questions if there. Casey.
So when you try to model the stochastic volatility, are you using generalized autoregressive conditional heteroscedastic?
So we've started, I'd love to answer that question.
Why not?
Who did I call? I called Rob.
You don't need to.
That's
you don't need
right.
to answer this question. That was a joke.
No, I'd like to answer this question. So I teach financial engineering. I teach people, I teach an asset securitization course, and most of my students are either computer scientists or they're engineers or they're physicists. And so they're really into these dynamic problems. So we've tried a lot with like deep VAR machine learning models to try to pick up these time series, and then thinking about the correlations, like how we you can't treat every point in space as independent. That's stupid. But when you look at these models, it's a lot of the machine learning models are not geared to time series estimation. They're very cross-sectional. But what we're finding is they're really good for spatial correlation, really good. And so we can, just like in banking, where the model of the land is logistic regression, very linear, completely unsuited to this problem. But the correlation structure and the sparseness of these data sets is a very big issue, and that most places don't burn every summer. So you have lots and lots of zeros and then some signals in all of this zero-ness that you need to fit. And then that's where Rob comes in. We now need to go out of sample and get this curvature right, but it can be done. We're very close to it. So right now we're using something called convolutional neural nets. They fit the topography really beautifully. They're a huge improvement on logistic regression, or sort of which is what everybody's using, or they're linearizing it and doing generalized linear models. Those are the models of the land right now. I think we're going to make progress on getting it out of sample. And part of that is realizing what these climate dynamics look like and working with the people that are modeling the sort of the differential equations that can pick up those dynamics, because we need those for pricing. So I'm actually optimistic. And what I see in students that are trained to start looking at this, the combination of computer science and engineering science and risk modeling, can be put together in very useful ways for people in fixed income, which is where this all started. We need to price the mortgage market too. We've heard this multiple times, but I think the easiest thing for us to price is going to be these retrofit models, mortgages.
And in short, she doesn't use generalized.
I have a bit more of an ignorant question. Forgive me, maybe taking a step back. Is there a cap on how much you can charge for insurance in California?
So that's a great question. So we have a dual market. We have a residual market, which is the California Fair Plan. And then we have the voluntary market until the insurance companies don't want to renew your policies. And then you go to the California Fair Plan. So in the voluntary market right now, there are still rate caps. And the cap is 6.99999, because if you do a 7% request, you have to have a public hearing. So nobody does that. So yes, by Proposition 103, which was passed in 1989, and it was designed by Ralph Nader. So that policy limitation has led to this brinksmanship of asking for, because they asked for multiple 6.999 increases. Now they ask for a 30% increase that happened in October. And that's where this new decree between the governor and the California State Insurance Commissioner to actually start thinking about using actuarial models to price the risk, and at least potentially to start thinking about reinsurance rates in the price structure. So that market is capped on price still, because it hasn't happened yet, but it's not capped on quantity. So if you want to, your insurance company, and you want to cancel the policy, you may do that. And then that policy goes into the California Fair Plan, which is not capped on price, but it's capped on a zero return. So it's a zero profit company. So you just have to cover your costs. So you can change the price,
Potential loss.
but it's zero profit. So we have a zero profit part of the market. Then we have another part of the market that's capped on price, but you can leave. That's our pricing scheme right now. Dysfunctional.
And you mentioned the look back 20 years.
Yeah, so the so because we can't use or we have not been able to use actuarial models, the risk is based on actual realizations over the past 20 years.
But that's a regulatory requirement.
That is correct. That's part of 103 as
But that-
well.
That's used for pricing, I suppose, right?
Yes, that's how you justify a rate increase if you're an insurance company.
That's to request the rate increase.
That is correct.
So the 6.99 is using a model that's insufficient.
Yeah, but you can ask for multiple 6.99.
Got it.
But you can't justify it with an actuarial model. You
Yeah.
have to justify it with an average backward-looking number.
Understood.
And when you look at climate risk, it's very flat until about 8 years ago, and then the slope is like this.
And you have clustering, I suppose, on
Oh,
the
of
bench,
course.
right? So
Yeah,
it's like
massive.
you might be on the verge of something, but you have to price it as if you're far away from it.
Yes.
Other
I
questions?
think,
Yeah, just a quick one. I think I'm curious your view on what it will take to keep some of these insurers that are pulling out in the state. And obviously the regulatory piece that you're mentioning is a big one here. But in terms of you mentioned the 5 feet rule and some of the actions that individual homeowners or business owners can take in their own
Yes.
hands. Curious kind of what you're seeing in terms of like incentives or credits. And it just seems like, as the more that the insurance sector is able to de-risk to, individuals, for example, the more likely they'll stay in. So are you seeing some of that kind of collaboration happening?
It will begin to happen, but it hasn't started yet. But the insurance companies are saying, look, this risk has to be it has to be pushed onto the shoulders of the insured. It's just we don't have mechanisms to allow that. Because if you get it, even with a discount, that's in the future, but you're going to have to do the retrofit today. You're the homeowner. And we haven't even started to talk about commercial real estate. And they have exactly the same problem. So I just spoke with Wells Fargo Bank recently. They funded one of our grants. We're working with them because they have to think about repricing. They're the largest commercial bank lender in the United States. This risk is already on their balance sheet. And how are they going to hedge that risk? I mean, they don't have tools to hedge it. And that's a great concern. So we have a lot of capital market solutions that really need to be thought about seriously. But that's great news. We train students. That's the human capital we're trying to produce for all of you. And I think there are wonderful opportunities to figure this out.
so I think we better stop. Is there
Time for
more?
one more.
One more, okay.
I'm not sure quite how to ask this question, but how much did a house in California cost, say in 2000? And how much does that same house cost today?
So, as you know, property prices in California have been rising incredibly rapidly.
That is my question.
Okay, the why of it is the lack of supply of housing. It's actually very straightforward. And the cost of producing housing. Most of the cost of a lot of these homes is the steel that takes it down to bedrock so it doesn't slip off these nice slopes where we all live.
You know,
It's very costly.
like yourself, I'm, a bit of an engineer, and I'm a bit of an economist, and I'm a bit of an accountant. And the bottom line is something is wrong in this whole numbering. I bought a house in 60 years ago nearly for $47,000. Nice house. It sold last few months back for 1.1 million in New Jersey. There's something wrong with something is fundamentally, confusing. I mean, the prices of houses in, my former wife, has a house in California. The reason I ask this question is because I think that The day's conversation has been very, very good about what it's talked about. But for me, the elephant in the room is how the economic structure of this country has completely changed since I've been here, which is now 60 years. And I'm excited about the technological position of this country. But for me, where is the value add in almost everything we do? The cost of things and the price of things, where is that delta? That's really, something I'm fascinated by, and it's something. There's a lot of value add that's getting sucked out by people that don't deserve it.
Well, that's going to be the subject of next year's conference.
Yeah.
But thanks for the question.